Alright, good morning everyone. Welcome to Phillip Securities Research Weekly Market Outlook. I'm Raymond. Today I'll take you through the outlook for markets, followed by Ken, who will take you through telcos. Alright, in terms of the market outlook, we think that the global economy essentially is in a fragile equilibrium. In the US, we are seeing the economy entering into a soft patch. We think for the US, it's likely to see a year of two halves, basically a weak first half, which last Friday's weaker than expected retail sales data, as well as plunge in consumer sentiment vindicated our stance on a weak first half. But looking ahead into the second half, we think the US economy is likely to rebound, as indicated by your capex, new orders, as well as your housing permits. In China, we are seeing near-term weakness on property curbs, shadow banking curbs, as well as avian flu concerns. So this morning, we had the China first quarter GDP data coming in, and that was weaker than expected. So that could lead to further near-term weakness. In the Eurozone, it's still in a fragile political and economic environment, and the Italy government will actually convene in Thursday to actually elect their new president. So in terms of asset strategy, we are overweight equities, market rate bonds, market rate commodities, and underweight gold. And in fact, today gold has been tumbling down quite a fair bit on concerns that Cyprus needs to sell its gold reserves, right? So in the second quarter this year, the main risk essentially is that of profit taking, right? Especially for equities, given the softer data in the US as well as the other G3 economies. But still, we think that the pullback in equities offers an attractive opportunity, essentially to accumulate our overweights in US, China, Hong Kong, ASEAN economies such as Indonesia, Philippines, Thailand, as well as, of course, Singapore. Right? We went through the first major risk event today, which is China's first quarter GDP, which came in weaker than expected. And today happened also to be the North Korean founder's birthday, so there's a small possibility of a nuclear missile launch, right? So moving on to the US, we think that for the S&P 500, after making new highs last week, we think that earnings are essentially critical to actually sustain this rally, because this rally essentially has been a multiples expansion rally that is not actually being supported by earnings, right? So and in fact, JP Morgan and Wells Fargo actually released earnings last week, and although that it has performed largely in line with expectations, but their stock still fell quite a fair bit. This shows that expectations have actually been quite high for earnings moving forth. And for the S&P 500, we see in the option market a lot of short positions on a 1,600 level, and we think that 1,600 is likely to be a psychological resistance for the S&P 500. Moving on to the Nikkei, the broader question is whether is Japan largely in a structural bull run. Before we answer that, we need to take one step back. In the near term, we think the Nikkei rally still has legs if the USD JPY can clear the 100 level. At this juncture, yes, it's just a whisker away from the 100 level, but the yen shorts are actually being squeezed early this morning after the US in its semi-annual review cautioned Japan to actually caution that it's actually monitoring Japan's currency depreciation with great interest. So what happened for the Nikkei today is that the Nikkei has actually fallen within its Bollinger Band, right? It's just slipped quite a bit, but we still think that the Nikkei is still in a structural bull run. Alright. Moving on to the Chinese market, largely in Greater China indices, we think there's a short-term downward bias. So as what we mentioned earlier on this just now, this morning we actually saw China's first quarter GDP data. So essentially China's first quarter GDP data essentially came in weaker than expected, right? Industrial growth as well as fixed asset investment has undershot essentially, right? And if you recall, last week we actually saw stronger credit data in China. So we think that this will actually pose a headache for policymakers because on one hand you have strong credit growth, and on the other hand you have weak economic growth. So this essentially means that the money from your strong credit growth is actually not moving into your real economic sectors, right? And that could actually pose problems of asset bubbles essentially in China. So moving on for the HSCI, although it fell quite a bit this morning, around 1 to 2%, we think that key support will remain at 10.5K level. For the Hang Seng, downward bias to key support at the 200-day moving average. For the STI, it remains in a tight consolidation mode. Since the opening bell is slipped about 0.4%, but we think that after it breaks through this consolidation range, it's likely to move higher and likely to challenge the 3,320 level followed by the 3,400 psychological level, so long as it stays above key support at 3,250. For the stock, the Thai index, we think that there's downward bias because it has been struggling to break through the descending slope, right? For the Jakarta Composite Index, we see a bearish divergence with higher highs on prices, not corroborated by momentum. In fact, momentum we saw lower lows. Last week, the Bank of Indonesia actually stood pat. We actually think that that is a policy misstep because you recall, Indonesia essentially needs to scale back on its fuel subsidies, which is largely unpopular, right? But it's something that has to be done to actually curb its fiscal strains, right? So we think that by standing pat last week for the month of April, there's a significant possibility of a steep rate hike cycle that Bank of Indonesia might have to implement in the months ahead, right? So although we are now overweight on Indonesia, we caution investors of this possible steep rate hike. For the KLCI, the 13th general elections is drawing nearer. There are two important dates to take note of. First is the 20th April nomination day, and followed by the 5th May polling day, right? As early as the previous 2 weeks ago, we have already indicated that the KLCI has actually decisively broken above the 50-day and 200-day moving average support level, and we look to actually overweight KLCI from our current market weight if Barisan Nasional, the incumbent, gained a strong mandate. By a strong mandate, we mean garnering more than, or rather reclaiming the 2/3 majority that it lost back in 2008. With that, I'll pass on to Ken, who covered the Singapore telco sector.
Hi everyone, this is Ken. Today I'll be talking about the Singapore telecom sector. Okay, so as you guys know, right, for M1 Start and Singtel, the share price has been rallying. So you'll be interested to know where we see the share price going moving forward. Okay, so what we'll be talking about today is I'll run through very quickly on the investment merits for the telcos, and I'll go on to elaborate what the upcoming changes that we would expect to see for the data monetizing and why it is key. Next, I'll touch very quickly on a comparison of the three telcos. And lastly, we'll talk about the valuations on why we prefer Singtel as compared to M1 and StarHub. So once again, the investment merits for Singapore telcos. this is probably relatively familiar to most of you. So the dividend yield is high, even at current price levels. It's 4.5% for Singtel and StarHub and 5% for M1. The telcos continue to have stable earnings and strong free cash flow, likely to be in the single digits growth year on year. There's also rational competition in the market, unlike other places such as India, whereby the competition is relatively much stiffer and they tend to price down each other. Also, the telcos have a growing customer base. This is both from population growth and from introduction of technological products such as your 3G tablets, in which you would require a SIM card to access the 3G data. So on the revenue growth, the traditional sources of revenue, that being your SMS and your voice, has been declining, and also that of your overseas international calling, that's also been declining. This is due to other players such as WhatsApp and Viber, and also there's changing customer behaviors in which people would, instead of incurring international data charges, tourists would actually buy a SIM card when they visit, for example, Singapore. And so the key to revenue growth would be data monetizing. So this would happen because of the high smartphone penetration in Singapore, and also due to higher data usage expected as people start using more cloud computing and video surfing, especially video surfing, as it is very high data intensive. Also, as you can see over on the chart on the right, you can see that this is actually from Singtel's recent investor day. Singtel actually expects data traffic to increase exponentially, as you can see from the red line over here, right? And also on top of as data increases, you could see that 4G is actually more efficient as compared to 3G, as you can see over here with the red line going down. 3G data is expected to, on a variable cost basis, to cost many times that of 4G costs moving forward. And this is going to be a very big positive for the telcos. So how would the telcos monetize data? Singtel has already indicated plans to increase access data price once nationwide 4G rollout is completed. So for example, right now you have an allowance of 3 GB. Should you use 4 GB, then you would have to pay an excess data charge for the 1 excess gigabyte. And right now for Singtel users, you are being charged around $5.35 per gigabyte of excess use. Moving forward, after the LTE coverage island-wide has been rolled out, it's likely to increase to approximately $10.70 per gigabyte. And we also expect M1 and StarHub to also follow such price increase. Another way in which they can increase their revenue is through the gradual increase in ARPU, average revenue per user, as people switch to the higher tier plans. So right now, for example, should you be using have an allowance of 3 GB and you're exceeding 4 GB, you might want to consider shifting to the higher tier plans, because the $10 increase in price for the excess data might be too excessive for you, and you might find it better to shift to the mid-tier plans. And should you do that, then likely you would be the revenue margins from that the telcos are able to earn from you will be higher. And also with the launch of 4G, Singtel and M1 have both guided that approximately like 17% of the new subscribers are on 4G, and out of this 17%, 9% have actually exceeded their data allowances. Another way that the telcos can monetize data is through further lowering of data caps. In Australia, which is another developed nation, they are actually only offering 200 megabyte as compared to the 2 GB that's offered in Singapore. So that, although plans have not been made, it is possible for the telcos to lower the data cap to as low as 200 megabyte. So besides the growth from data, revenue growth from data, the telcos can also earn from lower handset subsidies. For example, right now they could possibly have consumers pay more for their phones. Another way in which they can earn higher revenue, or rather net profit, would be through the change in handset brand. So for example, since typically an Apple smartphone would have lower margins for the telcos, whereas a Samsung smartphone would have a higher margin for telcos. So should the brand mix be more towards the Samsung brand instead of the Apple brand, then likely you're going to see an increase in revenue margins from the handset sales. Another way that the revenue could grow would be through broadband. M1 is a new entrant to the fiber broadband, and that has provided them with a new revenue stream. And for the others, there could be possibly be increasing profitability from higher price fiber plans as compared to the cable plans. On pay TV, the telcos continue to have pricing power. However, content cost remains high. So that's a very quick comparison. Our call on the two telcos is actually a neutral on Singtel and M1, and then reduce on StarHub. Just a very quick recap. Singtel is the only one with a geographical diversification, whereas StarHub and M1 are only operational in Singapore. This is likely to remain so. On revenue growth, you could also see that Singtel, we expect Singtel's revenue to grow faster than the other two. This is due to its higher market share, increasing market share in Singapore, and also its higher growth potential in the other regions that it has interest in. And also, you can also see that the P/E ratio for Singtel is a lot lower as compared to the other two. Singtel is at 13.7 based on a forward P/E ratio of our forecast, and StarHub is on 21, and M1 is on 17. So on valuations, why Singtel? So once again, the share price has been rising. StarHub has been rising by 49%, whereas M1 is at 26 and Singtel is at 21. This is much faster as compared to the STI, which is at 11%. However, as much as the share price continues to increase, the growth of net profit has been relatively flat, as you can see from the three lines over here. Right. So right now we have increase in share price and flat earnings. So what would this result in? This would actually result in higher price to earnings ratio, as you can see over here. This is actually a 7-year chart that we have put out from Bloomberg, and you can see over here that especially for the blue line, which represents a StarHub, the price earnings ratio has actually increased a lot, right, at current levels of 21 based on Bloomberg's data. And what this has also resulted in, because as price increase, dividends has also been relatively similar, and that's actually resulted in a very huge decline in dividend yield, as you can see over here. So previously it was very high, and right now you can see that it has declined a lot. One thing to note is that while StarHub and M1 has been paying very high dividend payout ratios of even above 100, Singtel has actually had a much lower payout ratio out of their net profit of 60 to 80%, and that also means that there is actually a probability that Singtel would be able to pay higher dividends would have the ability to pay higher dividends should they wish to do so. And also to note is that as P/E ratio for StarHub has been increasing, Singtel's P/E ratio has actually been relatively stable compared to the other two, in which their increase is more gradual. And similarly, the dividend yield has been also more stable. So our conclusion is that having talked about all this, our conclusion is that the telcos continue to have strong fundamentals. They could possibly achieve higher mobile average revenue per user through data monetizing and higher handset margins. They could also increase their revenue from the fixed broadband average revenue per user through the migration towards fiber. Also, they continue to have healthy free cash flow and resilient earnings. And for investors, you may want to continue investing in the telcos because the dividends continue to be attractive, and also there could be potential capital gains. However, that said, moving back once again, recapping from the previous charts, the current valuations for StarHub and M1 are relatively high, and with the increase in share price, the PE and PE rate, that has actually led to as I mentioned just now, the increase in price earnings ratio. However, the earnings once again the growth remains relatively flat, and therefore this has also led to lower dividend yield. And we forecast that given moving back one slide, we forecast that with the increase in PE ratio, this is not very sustainable, especially with dividends yields relatively flat, and so are earnings. And therefore, we of the view that capital gains moving forward would be quite limited, especially for StarHub and M1. So therefore, we prefer Singtel due to its faster growth of revenue as highlighted previously, the higher earnings potential, cheaper valuations, and geographical advantage of being exposed to growth countries such as Indonesia and Thailand. And with that, we'll take questions from the floor. Thank you. Hi, I'd like to take a question on Singtel. The question is, since PE ratio is higher compared to StarHub and M1 and lower dividend yield, why is it more preferred than the other two? Okay, the PE ratio of StarHub and M1 has gone up, but the earnings has not gone up. So at higher PE ratio, it could also, which is much higher as compared to historical PE ratio, there's a probability that it will revert back to mean. And so should it revert back to mean, it means that PE ratio is going to decrease. And since earnings are stable, what would happen is that would mean that your price could decrease. Whereas compared to Singtel, the PE ratio is lower and it's nearer to its historical mean. So any correction would likely be more gradual. And for Singtel, we actually do not expect a price correction because we think that current price earnings ratio is sustainable, especially given its higher growth potential. And dividend yield for Singtel is actually right now approximately that of similar to StarHub. And there is once again a higher probability for Singtel to increase a higher ability for Singtel to increase its dividend yield moving forward as compared to StarHub and M1. Another question on what's happening in India affect whatever's happening in India how it might affect Singtel. So as a recap, there's been some regulatory problems in India whereby they were the Indian government is saying that Singtel's associate Bharti does not have valid license to the 2G spectrum, and also they are contesting on that Bharti does not have 3G license in a few areas. Previously, Bharti has had the 3G assessed through collaboration with another telco, and right now the Indian government is saying that that's invalid. So how this would affect Singtel? Would it impact Singtel? It depending on how the legal proceedings go, there could be some downward pressure from this potential from these two government regulatory lawsuits. However, we continue to think that Bharti in the long term would be of a good growth potential and a good revenue contributor to Singtel. This is especially due to its very high subscriber base and that things are slightly starting to turn around, and moving forward in the long run, Bharti should remain healthy and sustainable. Okay, in terms of it's another question on the capex requirements for telcos. For the telcos capex requirement, for this year, for the upcoming year, it's likely to increase a bit. This is because there's due to the implementation of 4G, and also because of the higher quality of service demanded by the required by the government of Singapore. So this is likely to, of course, affect cash flow. And also moving forward, there's going to be an upcoming spectrum auction, and this, depending on the price that are going to be required for the licenses, it could also affect it would affect cash flow. Should the prices for the licenses be on an irrational side, meaning on a very high side, then this would limit the ability for the telcos to pay dividends. However, based on our current forecast, the cash flow would be adequate in meeting current dividend in maintaining current dividend payouts? In terms of debt comparison, just one more question. In terms of debt comparison, for the three telcos, their debt has actually been dropping over the recent quarters, and all three have the ability to increase their debt financing should they require.
Hi, good morning. Just to remind everyone that we have a company will be coming to Phillip Capital for a presentation to trading reps and clients. It's Rigma Marine Time. It will be on Wednesday, 12:30 at level 6 presentation room. Registration will close today, so if you are interested, please register by today.
Hi, let's answer Chong Wee's question of whether it's the STI in correction and how far do you think it will go. I guess for the STI, like we saw just now from the charts, the STI essentially, let me see if I can pull out the chart. Okay. Yeah, if I could refer you to this chart, the STI essentially, the STI essentially is in a tight consolidation range right now, right? So if it's a tight consolidation range right now. So what we think is that in terms of bias wise, it's still bullish, and after this tight consolidation range, it's likely to, if it breaks through this tight consolidation range, it's likely to challenge the 3320 resistance followed by 3400 resistance, and we suggest to accumulate any overweights. We suggest that any pullbacks will offer an opportunity to accumulate overweights in the STI. For the next question is whether the Devon's question of whether the S&P 500 and Dow Jones will actually continue its upward trends. We think, as we mentioned earlier on, the S&P 500 and Dow Jones has been hitting fresh highs last week, and we think that for this rally to continue, it has to move from being a momentum rally to one that's driven by earnings. And so we caution our clients as well as trading reps to actually pay great attention to the upcoming earnings to see if it could lend support to this rally. Alright, with regards to Chi-Chuan's question of whether gold will rebound or continue its downward trend. Now, so gold actually saw off quite a fair bit during last Friday's US session, followed by this morning Asian session. So we think that in terms of broad asset strategy core, we're actually underweight gold, right, since last year, and it's proven to be true so far. But gold at such an attractive price right now, and then if you do not have gold in your portfolio, it's worth actually entering, right? To actually, I mean, as a hedge against inflation, given that your major central banks are actually undertaking synchronized monetary easing. But having said that, gold essentially is a sentiment play, and we do not rule out any further downward trend, especially if Italy and Spain are being forced to actually sell their gold reserves, right? Which Mario Draghi has actually hinted for Cyprus. With regards to the next question of as to whether buy in May and go away is likely to occur, I think the concern is that April might actually be the new May, right? As essentially what we covered in the first slide, which highlighted that for the second quarter of this year, we think that for equities, essentially, profit taking will actually be the main risk, right? So there could be a good chance that essentially April might be a new May. But having said that, pullbacks still offer an attractive opportunity to accumulate overweights in the various regional equities that we have mentioned earlier on.
Hi, we have a question on whether the audience can access the archive for this webinar. The answer is yes. We have the archive available. So maybe I'll just take 2-3 minutes here to show you how to access the archive. You can, it's located at Phillip. You can access this website here. Just a minute. Okay, as you can see here, this is our Phillip website, uniphillip.com, and it will be stored here, webinar session. So all our past session are stored here, and we will upload the latest webinar as soon as we can, as soon as we receive the archive copy. And you also can recommend your clients and friends to access this webinar through this website here. So yep, thank you.
Hi. So there's a question on what is the target price for Singtel. So once again, the target price for Singtel is 331. The current target price I see over here is rather on the conservative side. However, that said, so what does this imply would be that we actually encourage for investors to switch from StarHub to Singtel, because once again, the PE ratio of StarHub is at a very high level. Upside potential is rather limited, whereas should, for example, some events such as an increase in interest rates in the US, that could possibly be a catalyst, or for example, an adverse development from the auction of like the license auction, such that the license auction is very high, that could be another potentially another adverse news event, and that could result in a correction in share price for StarHub. Whereas on the other hand, Singtel is a more stable share, is at a more stable share price, and in which we do not think that is currently a more attractive option as opposed to StarHub.
Hello. Hi, Joshua here. Okay, well, We have a question here on what are the good stock picks to accumulate during an STI pullback. Well, we have, if you look at our strategy, we have 3 picks. That is SIA Engineering, and then Pan United and Bousted. Okay, for SIA Engineering, as you know, they have a very strong position in, well, as you may know, they have a very strong position in being engine service, jet engine servicing, and they also have this 50-50 joint venture with Rolls-Royce. And so that just means that as many planes are flying Rolls-Royce engines, they will have to be serviced at the plant that they have here with Rolls-Royce. And since Rolls-Royce is probably one of the largest engine makers in the world, it's pretty much a guaranteed base load, and they have a guaranteed base load from SIA, and air traffic in Singapore is continuing to increase, and Asia Pacific wise, the total capacity of airlines additions are also very big. It's also continuing to increase. Pan United, we continue to like the stock because of its 1/3 market share in ready-mix concrete in Singapore, and also the port that it has in China. Macquarie Infrastructure Fund has a 30% stake in it, while Pan United has over 50. So, and Pan United has a right of first refusal, and as you may know, MIIF is looking to divest their assets. So an all-cash transaction with Pan United will probably see a re-rating of earnings per share. And Bousted, we like it because it has a pole position in geographical information systems, and the system that they market is the global leader. It's by a company called Esri in the United States. And basically the GIS that Esri makes is like the Bloomberg of GISs globally. So it's got a 60% global market share, and in terms of governments which use it. And so since Bousted has exclusive distribution and servicing in Singapore, Australia, Malaysia, and Indonesia, that's a very strong business mode that it has. Okay, thanks.
Hi, some questions on Singtel once again. Okay, one question is on what is the entry price on Singtel, and what are the actions that we recommend, and also, so on the entry price and what we recommend for Singtel, our recommendation right now is that we recommend a reduction in your holdings in StarHub, and instead you may want to consider increasing your holdings in Singtel. First of all, both offer similar dividend yield. However, Singtel has higher growth potential, and also has a more stable PE ratio, which is less likely to correct as compared to StarHub's 21. And at what price do we enter at? We think that at current prices, it would be a good price for you to switch from StarHub to Singtel at current prices. So which means that you immediately just reduce your StarHub and increase on Singtel. And in terms of how we derive on our target price, is actually based on a discounted cash flow model, based on a few assumptions. But we think that for Singtel and StarHub, or rather for the telcos, what is attractive about them right now is that investors are actually putting a very high emphasis on a dividend yield of 4.5%. This is, we would agree on the attractiveness on the dividend yield as compared to the other stocks in counters, because the average dividend is approximately 3%, whereas Singtel and StarHub and M1 offer much higher dividend yields. And also Singtel and StarHub and when we also see that there could potentially be an increase in our dividend moving forward. So therefore, this further increases their attractiveness. Furthermore, for Singtel, we reckon that the probability of an increase in dividend yield, they will probably have the highest potential and ability to increase dividend yield. Hi, one last question on Singtel. What's the percentage held by government? That's okay. Hi, one question on the percentage held by government for Singtel. That would Temasek actually currently holds around 51% of Singtel, and the rest are held by some instis and some retail.
Hi. Question here is Bellset SP a good price to enter now? I think it's not too bad. Of course, indices don't look. The broad market isn't fantastic now. But I think that the price that you enter now, I think, is not a bad price. My target price is 180, and I'm pretty well, I'm bullish on the stock. So I cover it because I like it a lot, and I think that it is worth about that price. Okay, thanks.
Okay, I think there being no more questions, so I think we will end today's session here. Thank you for being with us this morning. We would like to see you again next week, same time. Thank you.